We will now go to our high-level opening panel titled Where Capital Goes Next, Allocating Investments in a Fragmented World. And to lead and moderate that panel, I'd like to call on stage Mindy Lubber, the CEO of Ceres. Let's give her a warm hand of applause.
Morning, everybody. I will stand here for 2 minutes, but more importantly, I'll join my panel. We know what the exam question is for us in this particular session. In a world where, and I will come to that exam question, in a world where the dynamics are changing, the geopolitical situation is perhaps upside down, and to the extent my country has anything to do with that, not my fault is all I can say to you. But the changes in our economy and everything surrounding it are greater, larger, more impactful than anything we've seen. And what we do know is the future will depend on finance. Where are the capital flows? Where are they coming from? How are these new forces of change, be it a war, be it AI and the data centers that are growing out of AI and the largest increase in demand as it relates to energy? How are we responding to that? And most importantly today, the exam question is, how is the financial community responding to that? We've spent the last decade, I would argue, building out the arguments around risk, why climate change is not only a scientific imperative, an environmental mandate, but why it is about our economy and how it's going to shape the future of our economy. Our panel today have experts who can talk about how in their real life, what they are doing every day, today, tomorrow, and the next day, are being shaped by the transformational changes we're seeing and how they're moving forward. There is no greater time for dealing with the dynamics that we're dealing with. Just think about it. $2.3 trillion invested last year on the clean energy economy in the future. What's going to be invested next year? How do we meet those goals for doubling that and tripling that? What are the changes that are needed to be made? What are the policy implications? That's a lot of stuff. We will try and narrow this panel, and I'm going to sit down now, and really look at how financial institutions are reacting to these changes and what we could do today, tomorrow, and the next day. My final point is, many of us during this London Climate Week that has doubled in size or tripled in size, feels like New York Climate Week now, where there are 100 events going on at one time, and we're running like idiots, or I feel that way, from bouncing from one event to another in one reception. Some of them are theoretical and some of them are very practical. What I have heard, the mandate for today and the exam question, what are the practical things we could do? What do investors need? What do corporate needs? What are the policy changes that we need to make sure we take that number of $2.3 trillion and double it next year for moving a green economy forward? So enough from me. We've got extraordinary experts who I'm going to allow to introduce themselves a bit better than I will. What I do know, and I've talked to them and studied their backgrounds, these are people who are the movers and shakers, changing where we're going, what our future looks like. And I will ask them many exam questions about where we're going and what they're doing. So please welcome me up here on the stage right now, my full panel. Great. Let's start from my colleague at the Milken Institute. A very quick description of who you are and how you all are looking at these questions, and we will work down. Let's do that fairly quickly so we can get into the meat of the matter, or some say the tofu of the matter.
Yeah, absolutely. Thank you. And thank you for having me today. So Matthew Aleshire with the Milken Institute. We're a nonprofit, nonpartisan think tank, really dedicated to bringing capital to solve a number of global challenges. That includes the health space, but most pertinently today in the climate resilience space, infrastructure being core to one of the areas that we really focus on. I lead our Geo-economics initiative, which cuts across all of the Institute's offices and markets that we focus on. We're headquartered in the US. Some days that's great. Some days, depending on the tweet, may not be so great. But we also have a presence here in London, Singapore, the Middle East, and Latin America. And really what our work is focused on is navigating the most disruptive trends that we see taking place. So AI, supply chain disruption, and really the overarching one that cuts across all of that and is really the only existential challenge that we face is truly the climate related challenge. And so we've chosen to center that and include it in geoeconomics because it is both a source of disruption and also one of the largest global challenges that we really need to solve. So I'll stop there and
Great.
we'll come back to that.
And what I'm going to do to sort of hasten this to get as much substance out of these four incredible experts is to ask a question as well as ask CK, who is next from Cathay, to both tell us a tiny bit about himself and the firm and how they are a leader on nature and water and looking at climate. But let me ask, in addition to your introducing yourself, and thank you for doing so, how are you all at Cathay looking at the geopolitical fragmentation, the trade tensions, the shifting industrial policies reshaping our markets, and more importantly, how are these forces changing what you do or what you think the investment priorities of major institutional investors should be moving in, and which sectors or regions stand to benefit most? Those were three exam questions. Obviously, choose as you like, CK.
Should I answer right now?
I'm going to ask you to both introduce yourself and yet start answering that question, and I will fire more to each of my colleagues.
Okay. Well, I understand the geopolitical challenge is the master answer for me in a lot of occasions. I'm CKD, CEO of Cathay Financial Holding Companies. We offer comprehensive financial product to the customers, and we have the operation across the Asia. So we continue to expand the investment and financing in the renewable energy, the energy storage, and the other stuff. We think this is very good direction for financial institution. We utilize our strengths, financing and investment and capital, and also we utilize the partnership with the global initiatives. We learn from those initiatives, and then we bring those ideas back to Taiwan to share with our customers and our peer companies. So we continue to do this in the past 15 years, and we love it, and also we will continue to do that. When we talk about the geopolitical uncertainty, the economist reported several times, Taiwan is the most dangerous place in the world. Taiwan is the most dangerous place in the world. Economists reported several times. But I give you some facts. I read an article yesterday. Taiwan stock market capitalization ranked number 4 in the world. Can you imagine? Taiwan is a small island, only 36,000 kilometers square. A small island with 23 million population. How can we achieve number 4 in terms of market cap in the whole world? This is the most dangerous place. On the other hand, you can see NVIDIA, Google, Microsoft, AMD, even Ismail, all the first-tier company increase their investment and expand their operation in Taiwan. Why? Do they don't care geopolitical uncertainty? I do believe they care. And let me talk about how we think about the geopolitical uncertainty issue. Taiwan is a small island. As an island economy, so Taiwan cannot rely on a regional power grid for support. So, but on the other hand, Taiwan has a very strong manufacturing, say TSMC and the other manufacturing industries. They really need enough clean energy, stable and continue to go in. So we fully understand this is the issue we need to take care. So this is the reason why Cathay Financial Holding and the other financial institutions, we continue to invest in the renewable energy and clean energy. So we understand we cannot control the geopolitical uncertainty, but only one thing we can do is we try to strengthen our resilience through investment, financing, partnership to enlarge investment scale, try to build up the solid foundation for the energy transition and the energy security. So that's what we do, and what we understand the issue to us, but we do what we can do, and we just demonstrate the facts to the whole world.
Great.
Thank you.
Thank you. And it seems so obvious, right? We know there's a problem. You're hedging against it, getting ready, investing in renewables. I wish everybody was doing exactly that, and we'll come to the full panel. Stephanie, my old friend, who I haven't seen you in years, and that's the nice thing about being here. There is money going in. The capital flow, when we talk about $2.3 trillion, that's a lot of zeros. That's not small change. Are you seeing that across the board? Institutions getting ready, being smart like we just heard, and really doing what it takes to move capital flows in the right direction of a green energy economy?
Short answer, yes. So I'm Stephanie Maier. I head up our sustainable index business at FTSE Russell, and we work with asset owners, asset managers globally on implementing sustainable climate and sustainable thematic investment strategies. You know, we design indices as benchmarks, but importantly, we work with asset owners to implement essentially investment strategies for listed equities, for fixed income. And as part of that, we're absolutely seeing those designs essentially shaping the flow of capital. And, you know, that is in the billions. We now have more than 100 billion in strategies tracking our low carbon transition indices that use data from our partner Transition Pathway Initiative to help direct that capital towards those companies that are actually better prepared for that climate transition. You talked about we're very good at talking about risks. We're also increasingly, in the investors we work with, looking at those opportunities. You know, who are going to be the beneficiaries from the low carbon transition? So yes, it is still very much about how we manage those risks, but it's also about how we target those companies that are proactively investing in the transition, that are deriving revenues. And earlier this week we had our green economy report talking about how the green economy is growing substantially, is being able to help our clients access those opportunities as well as manage those risks. So as we've known each other, I've mainly been in the asset management industry, but I think within index, you're really starting to see the scale. You're starting to see those billions flow. You're starting to see asset owners not just look at how they're allocating their capital, but through the signals that they're sending, the engagement that they're doing alongside index construction, really starting to shift that capital. And that's really important, and that's good from an investment perspective as well as from the managing the climate risks as well.
Great, thanks. So let's take that even to the next level of detail, if we may. We're seeing growing trends, 2.3 trillion, a lot of money. Index is showing us very clear progress. Banks, insurance companies, financial institutions moving a bit quicker. You advise a lot of smart clients, and they're looking to you for smart ideas and information and direction of travel. What are you telling asset owners or insurance companies or general economy folks how to get into this world and what they ought to be doing literally this year or next year, not 5 years hence? And introduce yourself as well and your firm.
Really good question. So hello, everyone. I'm Shuayb Ismail. I'm from Baringa. We're a global impact-focused commercial advisory firm. I think we're the two Londoners on the panel, so we're going to apologize for our weather and our train system. There's like a happy 2 degrees where London works really well, and anything beyond that, we break down.
Does that mean Matthew and I have to apologize for the United States if you're apologizing for the weather?
I'm not going to step into that terrain.
Yeah, nor am I.
But it's a really good question because we, within Baringa, I lead on our sustainability strategy work. The focus we always have is how do you put the commercial investment number behind sustainability, because otherwise it falls into CSR work. Anytime there's any form of economic or financial instability, it gets dropped. And as you mentioned, we advise a lot of investors, a lot of firms. I just flew back from Sydney last week. I was in Singapore before that, Korea, etc., talking to investors around where they should be allocating capital. The thing that we're seeing is there's always been two parts to the investability case. There's been the project side case, and there's been the system side case. The balance that we're seeing at the moment is the focus is shifting a lot more to the system side. Is the system investable by itself and not just the project alone? What we're seeing is, to your question, there is a conflict between climate objectives and system readiness to enact those objectives. I'll give you one example. We were working with one of the largest infrastructure investors recently, due diligencing a major data center investment that they're going after. One part of this investment, a major campus, was fed by coal power. It was coal power that had already been built. 5 years ago, even, that would have been a red flag for the system. Now, today, the question is, how do we take that through to an IEA or an NGSAF 2040 deadline as close to the Y as we can, because we need stability within that system. The thing that we advise different economic actors when we're advising policymakers, the question we're asking is, how are you making your system as ready as possible to de-risk elements down there, whether that's strong carbon credit frameworks in place, whether that's putting flags in the ground of where your energy system is trying to get to, whether that's prioritizing specific supply chains that you want to focus on, whether that's supporting corporates to enact advanced market commitments to support green infrastructure within the system. How are you making the system as ready as possible so that investors see that as de-risked and then can focus on the project side economics by itself? That's a big gap that we see, and that's where the conflict comes in, but also where alignment can really be built.
Great. Coming back to you, Matthew, on how do we make sure that alignment starts to happen?
Yeah, I think that's the key question. And I think one of the tensions that we're seeing right now is, as we talk with investors, and I should be clear, we're not in the investment advisory business, but we do convene a number of investor groups that we bring to bear in a number of those areas that I mentioned earlier for bringing capital to solve for specific challenges. As we look at sort of the geo-economic or geopolitical moment that we're in, the sort of reversion or re-emphasis around energy sovereignty, agency, autonomy, and economic competitiveness has created a moment where sort of a renewed focus on infrastructure in particular, climate mitigation, those areas are coextensive. To what extent they're at cross-purpose depends on who you're speaking with, right? And I think one of the key areas as we work with policymakers and investors is discerning where policymakers can provide a degree of stability in their signals to investors. I mean, I think that's, yes, very simple to say, very straightforward, but sometimes it's easier said than achieved, right? And there's a few examples here, and I'll go back to the US for one example recently where the solar generation in the U.S. recently passed coal for the first time. I believe it was a month and a half ago. Right. And that's a big deal in the U.S. Now, usually you could say, yes, of course, May is typically when solar generation peaks in the United States heading into the summer months. And then other forms will come in and pick up the demand on for air conditioning in particular over the summer. But again, that's no small feat. And if you look at the lead 5 states where that build-out has taken place over the last few years, that's actually been in all states that voted for the current president of the United States in 2024. So the underlying market structure has shifted there. The investment opportunity is very clear. That investment's not being made because of tax incentives from those states and those locations. It's because the underlying economics have shifted, and the fundamental reality for investors is that they're following where those economics are. I think when you look at short-term signals, and this is something that we're helping entities sort of discern, is the president at the same time in the United States, just coming back to that example, also recently announced, I think it was $730 million for coal facilities. That's not good news at all, but that is a short-term signal that is unlikely to shift sort of long-term structural considerations in the U.S., right? You could view that as a last gasp to try to prop up a political sort of industry that's politically important, I should say. And so I really think that that notion of certainty from policymakers and the extent to which they can provide it in key geographies is really the factor that discerning investors are looking for globally.
I think it is an important point you just made. There's an enormous amount financial institutions can do, and they are doing that, but without the right price signals and without the right policy, it is hard to have the massive political and non-political, the massive economic changes that we need. I mean, a number of points were made by my colleagues, and then I'm going to ask one more question, but I also want my directors here to give me a sign as to when we need to start taking questions from the audience. But I will say we've affirmed that this is a complete economic message. This is about materiality and not morality. This is about systems change and not one project and off. It is about how to change how we look at systems. It's about changing times, whether it's the war, whether it's data centers, whether it's geographical unrest. Let's look ahead for a minute and think about over the next 2 or 3 years, what needs to happen? What do your institutions need to be doing to help make sure that we go from that $2.3 trillion to doubling that, which is what these smart economists, and I am not one of them as an environmental lawyer, I try and read those charts and understand them. But truly, what do we need to do to turbocharge the investments in the clean energy economy, which we know makes sense, we know creates jobs, we know is the future. We can't not look towards that future, but what do we need to do to get there? Let me start, and we'll work this way down the panel, and then we'll take a few questions.
Yeah, it's a good question. So the problem statement is, how do we grow the pool of climate finance that's going into the areas that we needed to go into? One of the things we're doing at the moment is setting up a global major climate fund that's looking to channel billions of dollars worth of funding into emerging markets. There are 2 parts to that problem statement. One is, does the capital exist? And the second is it being enabled to channel into the right places? Across every investor I've spoken to, and I'm sure this is going to be resonant with the rest of the panelists and everyone in the room, there is a lot of dry powder out there. Whether I'm talking to investors based in Canada, in the US, in Europe, in Asia, in Africa, everywhere, one of the first questions I get asked is, can you recommend a pipeline of projects for us? Because we're struggling to find projects. The subtext behind that is not that there aren't projects out there, it's that the projects aren't being presented with the right investment cases. That's the key thing. The capital exists, the investment cases do not, as yet. And the investment cases don't exist not because people aren't creating investment cases, it's because they can't compete with the system risks that are down there and the other competing priorities for defense, for AI, for supply chain security, for short-term risks, investing into coal plants, etc. What we need to get better at, the first thing I'd say, is building much more stronger investment cases that can de-risk system volatility that will come down the line. One of the big principles we have within Baringa is we will never build an investment case that's hedged to policy, because policy is way, way too fickle. We've seen so many times where billions of dollars worth of investment in Europe, which is supposed to have a strong environmental policy framework in place, has changed. There have been political signals to changes to carbon frameworks or carbon targets, and we've seen major investors just pull their investments directly out of the market. So we won't build investment cases hedged to policy. That's the first thing that we'll do. The second thing that I'd recommend is we need to get really focused on building the investment case for adaptation and not mitigation. More than 90% of all climate finance is focused on mitigation measures, which is fair, but we're in a world where we're not going to hit 1.5. We may not hit 2. We'll likely hit higher than 2. I can see a thumbs up, which is not normally the message I get when we say we're going to hit 2. It's normally a depressed face. But the point is we need to get better at channeling finance into adaptation measures and into adaptation measures where it means the most. Where system risk is highest is in emerging markets, where climate risk is highest is in emerging markets, where adaptation need is highest is in emerging markets. We need to figure out how we build that investment case. That's one big thing that we're focused on at the moment.
Great, and that's great, and a very important point. It is one thing to be focused on mitigation, and indeed we need to, but we've got to be focused on resilience and adaptation because that's the world we're moving into. Stephanie, what's going to change to get us to doubling that 2.3 trillion?
Yeah, I think it's worth reflecting on, and as the panel has, on what's changed and what's changing. And it is a very different environment. And I think where actually a lot of investment actually was probably more hedged to policy because it looked directionally more consistent. It also looked like it was, geographically going to continue growing. And I'd say, there are still really key markets where that is the case. You look at, Japan and GX, you've got some very specific policy measures there to encourage the transition in particular. I think it's looking at, how do you support investment strategies that work in more volatile market conditions, essentially. But also, how do you use those to signal? And I think the signalling impact of capital is just as important to actually keep focused on that longer term trajectory and the longer term investment performance. And we work with a lot of asset owners that have that vision, that can see what are the markets doing right now, but actually if we go back the sort of 5 years, what do we think is going to happen in the next 5 years? Okay, that's the kind of perspective, and for asset owners that's then another 10 years, etc. So I think partly it's also partly is how do we think about those things that are changing near term, and how do we make sure those strategies are cognizant of the changes, but also how do we look through some of that noise to the longer term opportunities. To your point about some of the kind of adaptation, resilience, nature we had sort of earlier, I think we're also seeing that there's a sort of a more holistic view of climate, nature nexus, but also social. This is a social shift that we're seeing as well. So I think, how do we make those strategies richer, but also how do we stay the course for that long term and the long term investment that needs to be there, and how do we use the capital also to signal the types of behaviours we want from the companies that are essentially being allocated capital to. The system piece, I think, is really critical as part of that.
So you're talking about not only how do we finance the new wind, the new solar, the new hydro, but how do we embed sustainability into every major capital market player, whether it's an investor or large companies. Of the couple hundred large companies we're talking to, we are looking at how they are moving their own capital into this space. So we're able to really generate the numbers we need. CK, how do you answer that question? And as well, I'll say I just came from something that many of you may have been at or not, Ecosperity in Singapore, where I'm not sure I've seen a more enthusiastic, focused, disciplined group of investors. I'm going to guess 80% were Asian investors, but certainly not all, on a belief in moving forward on a clean energy economy. How do we get to where we need to go, and what's driving that energy, so to speak, in Asia in particular?
Well, actually, in recent years, we continue to expand our investment and financing, not only on the offshore farm, solar power plant in Taiwan. We also expand the financing in geothermal in Indonesia, the wind power in Vietnam, the sustainable aviation fuel in Singapore, and also the storage system in different countries. So definitely we understand, for example, in Taiwan, we really need more renewable energy. So as a financial institution, the one thing we can do is we just try to expand the investment. But one issue for me is not a promising projects without sufficient structure that can be bankable, investable, or scalable. Not the issue. So recently we tried to say we joined the ABPN's Asia Clean Energy Transition, and also we participate in the Green Investment Partnership. We try to utilize those initiatives and figure out a formula to de-risk those promising projects. And suppose we have such kind of arrangement and make those promising projects be risk adjusted, and then they can be attracted by the large institutional investor. So recent years we try a lot effort try to promote the blended finance model, not only in Taiwan and also on the other Asia countries. We feel maybe this is one way that we can accelerate the investment in some promising projects. Otherwise, for financial institutions, definitely we have our financial hurdle. So this is the issue to us. But we feel maybe the blended finance is one way we can accelerate the investment and financing.
Great. Matthew, when you look ahead to the next 3-5 years, where do you believe the next $1 trillion of transition-related investments will be deployed, and what do we need to do to make that happen?
Wow, that really is the trillion-dollar question. I think, so from a geographical standpoint, I think Brazil I've been highly impressed coming out of COP30 with the specific example that Brazil has set from a policy-making standpoint domestically, but also working with multilaterals, the Inter-American Development Bank, around a number of innovative financing programs there, a currency hedging mechanism, et cetera, to set a path forward, or at least a sort of a framework that other countries around the world can use to sort of set their own path forward here. And so I think that there are models out there that are working. Coming back to Southeast Asia, you mentioned earlier, I do think sustainable aviation fuel coming out of the current moment and the lessons learned from the Strait of Hormuz closure, I don't want to give the current US president any credit for some of the lessons learned from this, but if there is a silver lining, it is that a number of entities have been forced to look at what the world, what their balance sheets would look like in a world in which oil is at $100 a barrel, right, or above. And I think that what that has triggered in terms of the thinking for long-term planning over the next 5 to 10 years gives me specific hope around the direction that investors and more specifically companies are taking as they try to manage risk on their own balance sheets. I do want to pick up on one other theme here too. When we've talked about Project Pipeline that has come up, for me, I think that's a core message and theme and something that we've tried to solve in a number of different geographies. I think it is difficult. There's no silver bullet there, but it really is ultimately sort of the challenge in terms of aggregating smaller projects so that sort of larger institutional investors can come in at scale, whether within a specific industry, whether that's critical mineral related, if that's battery offtake related. Those are areas where we continue to see growth, and I think over the next 5 to 10 years, that's enormous opportunity there across geographies.
Great. Let's take a couple of questions, then I want to honor the time. One question. Thank you. And if we don't get one quickly, I'll ask.
There's a gentleman there.
Great, thanks very much. Dean Cooper, I'm the Global Energy Lead at WWF. I'm interested to hear from the panel just examples and experience of this sort of big picture economic assessment. So we know that energy creates climate change. Climate change is one of the leading factors for biodiversity loss. We used to talk about climate change as being the driver. Now we don't. We talk about energy security, energy economics. We try to convince people that fossil fuels need to be phased out. We need renewable energy plus electrification, etc. If you do a direct comparison in economic terms, renewables comes out better, except if you've got existing plant in place, of course, then it becomes a more difficult comparison. Except if you take account of the bigger picture. If you look at the impact on nature, the economic impact of that, the healthcare issues, the water-related issues, are there examples that FIs are actually using or methodologies in place to look at this full economic assessment of the big picture to decide upon where the investment should be taking place and justifying that in renewables? Thanks.
A good question indeed, since we're looking at the changing geographies, the changing world, the increased demand from things like data centers, or getting us focused on certain things when we need to look at the big picture. Can you have sustainable fuels? What does that mean to ag? And so on and so forth. Let me see if any of my panelists would like to answer that question.
I'm happy to. So I think, rather than explicit metrics, I think what's informing a lot of the interest and the desire to develop climate-based strategies is actually recognising that climate is a systemic risk, and it's systemic for a lot of the interconnected reasons you've stated. So I think in terms of understanding that big picture, that systemic risk framing is very much what's shaping a lot of the desire and the investment intent. I think the climate energy framing, I think, sort of covered. I think the question is what's top of mind. Top of mind is absolutely energy resilience, security. What's a good way of addressing that? Well, that is domestic renewables, that is also energy efficiency, that is a lot of the measures that we know we have available, but actually what's that catalyst? And I think when we're talking about kind of mobilising, it is about what is the catalyst, and it's not just one catalyst and we all continue on a nice smooth road. We kind of need a catalyst and we're reminded there's another catalyst and then we kind of keep going. So I think we should be expecting obviously not a straight path, but I think there's enough there to continue to sort of drive that capital to drive the incentives to be looking at this as a systemic long-term investment issue, which means we need to be allocating capital accordingly.
Well, we're going to break in a minute, but any other quick thoughts in response? Because that's a very good question. Without looking at it as a system, we don't really solve the problem.
It is a very good question. I feel like I should ask you something that we've not met before, because you gave me a very good platform to plug something.
Okay.
So
very quick plug.
It's very quick plug, but it's in direct answer to your question. Is there a framework that helps asset owners or investors at large figure out the broader impact of the investments they're making, rather than just focusing on the narrow purpose by itself? No, is a simple answer. There is a big gap in the market for that. There is a framework in place called planetary boundaries. It was developed some time ago. There are a few different asset managers and asset owners that have incorporated it into their frameworks, but it's not something that's systematized. We launched a report specifically talking to asset owners around how do they bring planetary boundary frameworks, whether you're looking at climate or water security or nitrogen cycles or chemical pollution, etc., into their decision-making framework. It's really difficult. My recommendation to answer your question is, I can give you the report afterwards, go to figure 11 very specifically, because what we've done is we've taken some of the most important sectors and modeled out on a double materiality framework which parts of the planetary system are most material for themselves. Because the thing we have to remember, ICs have very little time to think about an investment decision. And within their investment decision, they're now not thinking about the project economics, they're thinking about FX volatility, policy volatility, a whole range of different things. And on top of that, we're telling them also think about emissions. And then on top of that, we're telling them also think about nature and biodiversity and water security. No one can do all of this. What we need is a way to simplify it. And there isn't something in place, but hopefully this takes a step down there.
Great. Well, there are tools. There are big questions, but I think they're being answered. We have moved from risk to opportunity. We're certainly focused on materiality and not morality. We've got a systems change look. I would urge everybody in the room who's both looking at projects and systems, collaborating, working together, and in the end, we are going to need some policy changes. What happens in Singapore or what happens in Taiwan will be different than the US or Brazil, but we need to make sure we are all focused on changing the systems through policy as well as through specific institutions. Thank you all. You're each great leaders and doing great work, and we all appreciate it.
Thank you very much.